This is Mike Lingle from Rocket Pro Forma, and today we're going to talk about how we account for expenses. So we can start simple. Revenue minus costs or expenses gives us a profit or loss. That's the way we think about it in our heads. That's the way we run our own personal finances. And the costs of a business, it's the cost of creating the product or service. There are people, especially in modern companies, salaries are usually a big chunk of the expenses. There's sales and marketing, which is attracting customers. And then there's everything else, right? Rent, insurance, lawyers, whatever. And just remember, public service announcement, remember when we're doing our financial projections for early stage startups, the revenue is usually pretty imaginary, but the expenses are real. So just be aware of that. And I like being a little bit conservative when I project, especially because I'm going to have to come up with the money to pay the expenses, and the revenues may take a little longer to materialize at the level I would like. So the way we account for costs and the way your bookkeeper thinks about it and the way your accountant thinks about it, cost of goods sold is the cost of creating the product or service. Operating expenses are the cost of running the business, acquiring the customers, delivering the product or service to the customer, and all the things, rent, lawyers, insurance, etc. And so on the income statement, you'll see these two categories of expenses. You may, in your head, think of it all as expenses, but to work with accountants, to work with bookkeepers, to submit your taxes to the government, your business taxes, you're going to need these two categories. Then on the income statement, there are, after the operating expenses, you get EBITDA, but that comes before interest, taxes, depreciation, and amortization. I'm not going to talk too much about that, but EBITDA is usually at the bottom of the income statement. And then you have capital expenses, which are larger expenses, which are depreciated. And so capital expenses could be an office build out. They could be buying expensive equipment. They could be buying an office, buying a building, buying land. It could be molds or tooling for manufacturing something. But these items don't show up on the income statement, but they are cash expenses, so they show up on the cash flow statement and the balance sheet. And then what depreciation is it just means writing off part of the value of something over physical something over time. So we depreciate physical assets, we write off part of the value as they decline in value over time. We can also amortize intangible assets like brands. If we were to purchase another company, the brand of that company is an intangible asset that we can amortize over time. We're not going to talk about that. But these are four categories that come in very handy when you're running a startup. And each of them has a catchy abbreviated name. So cost of goods sold, we abbreviate as COGS. Operating expenses are OPEX. Interest, taxes, depreciation, and amortization. We talk about EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And then we have capital expenses, which we refer to as CapEx. And of course, this is all because of accountants. But you do need to know this stuff. And I'm not an accountant, so I can give you some guidelines. But for any specific questions, please check with your accountant to understand exactly how things get categorized. So I've done some other videos talking about cost of goods sold. That's the cost of creating the product or service. But we're going to talk here do a little bit of a deeper dive on operating expenses. So typical operating expense categories, there are three main ones. There are sales and marketing, which is everything that goes into acquiring customers. There's research and development, which is everything that goes into sort of next generation products. In a software company, this is where the creation of the software lives, not in cost of goods sold, a little bit confusingly. And then general administrative, which is everything else, rent, lawyers, insurance, and also logistics and fulfillment. If you're doing a physical business, the shipping to the customer lives in general and administrative expenses. And so inside sales and marketing, again, this is everything having to do with customer acquisition. And we keep it separate so we can do some calculations around cost to acquire a customer. Everything customer acquisition lives in one place, so we can do the math and see what the global cost to acquire a customer is. But inside sales and marketing, we'll find salaries. That's obviously a huge part of the expense. Sales commissions, advertising, marketing, such as branding, events, PR, social media, SEO. subscriptions and expenses, the tools we use to accomplish our sales and marketing, our CRM, our email automation, our landing page. Inside research and development, this is, again, a lot of salaries. It could also be outsourced software development and outsourced testing. It's anything that's going into building the next generation of our product or service. And research, obviously, goes into research and development. Also, subscriptions for the tools we use, such as Jira and GitHub, when we're building software. But it's not onboarding and customer service. Those live inside COGS. So just keep that in mind. So your customer service people, even though they work very closely with the development team, they may be categorized differently from an accounting perspective. And the last category is general and administrative. And so here, again, salaries are a big chunk of this. This is where our executive salaries live and also where our admin salaries live. Rent, utilities, insurance, professional services, our lawyers, our accountants, our bookkeepers, travel and meals. Also, our email, our Office docs, Microsoft 365, G Suite, and also our fulfillment, logistics, and warehousing. And often our credit card expenses live here too. If we're taking some payment through credit card, those expenses live here. If we're taking all payments through credit cards, we could potentially categorize the credit card expenses as COGS. So with credit card fees, I put an asterisk there just to remind us to ask our accountants where we should categorize that. And so again, the three categories for operating expenses, just to review: sales and marketing, research and development, general administrative. And when you use Rocket Proforma, you'll see that everything's divided into those three categories with a separate category for COGS. And so interest, taxes, depreciation, and amortization, we get this EBITDA, which is earnings before interest, taxes, depreciation, and amortization on the income statement. This is a metric we'll use a lot in startups, especially with early stage startups. We probably don't have a lot of taxes and we may not have a lot of depreciation. So EBITDA becomes kind of the guideline. In later stage companies, EBITDA is often what you're acquired on. So if you're making money and you get bought, they will often make an offer for an acquisition price that's a multiple of EBITDA, and that's industry specific. And then capital expenses are equipment, so expensive computers, not inexpensive computers. Again, ask your accountant. Office build-outs, other equipment you might be using, molds and tooling for manufacturing, but the raw materials are COGS. And again, some molds and tooling may be COGS. Ask your accountant. Buildings, land, large expensive purchases that we're going to have for a long time and that we're going to depreciate for a long time. So your Mac computers you might be able to do as a capital expense because they're so frickin' expensive, but the Windows machines may just be an expense because they're not nearly as expensive. And so on the income statement, again, you'll see a few of these categories that we just talked about. You won't see the capital expenses, but you will see, you'll see the revenue come in, you'll see the cost of goods sold, then the gross profit, then the gross margin. Then you will see the operating expenses, and then you will see the EBITDA. So that's how all of these things fit together, and that's how the three financial statements work together. And again, one of the things I did to get all of this straight was I started doing my own bookkeeping, which really, really helped me understand how all these pieces fit together. And then I stopped doing my own bookkeeping. I don't do my own bookkeeping anymore, but it was great. It was a great learning experience. So that's it. That's how we think about expenses. Let me know if you have any questions, and we're going to jump, check out the next video, and we'll keep learning. Thanks so much. This is Mike Lingle from Rocket Proforma.